parody on that, and it's good. You'll have to check it out. I just posted it on Facebook recently. So
I'm thinking about what that, like, the hands reaching out, like, is it something about that? Like, don't reach out?
Friends,
okay.
Washing hands, reaching out, not touching you.
That's funny.
All right. I believe that we are officially live on Facebook right now. And so if you're joining us and you happen to just catch that bit, you're welcome. That won't happen again, I don't think, for the rest of the video. But what will happen and what's about to happen is a live Q&A session with a mortgage broker or mortgage advisor and broker that we really trust a lot. I don't know how many times I call this guy during the week and say, hey man, especially right now with all the things that's happening and what's going on. And so what I wanted to do is make sure that that you guys, the people that follow our page, my friends, my clients, that you have access to the same information that I'm getting. And so I want to introduce you to Drew Shade, mortgage broker and our mortgage advisor broker.
Both work.
Both work. All right, cool. You guys, this is a live Q&A session. So if you have any questions for, I have a bunch of questions for Drew, but if you have questions, drop them in the chat. We're monitoring. We've got my team on here. We've got Katie and Laura, and we're monitoring any questions. So if you have some, drop them in. We're going to get them addressed. And if you're watching this after we're live and you have questions, drop them in the comments, and we'll address those as well. Maybe just offline through a message or an email or something like that. So by the way, whoever asks the best question, whoever can maybe even try to stump Drew, will win a $25 gift card to iTunes. So you can, obviously apply that towards a movie or a show or whatever it is you're into right now. We'll get that sent over to you. So whoever can ask the best question will be the winner. Can
I try and stump myself? It sounds.
Yeah. No, we need you strong right now, man. No stumping. I don't know if you can stump yourself anyhow. I really do. I really do appreciate your advice that you give, and you're such a man, such a wealth of knowledge, and I really appreciate you. You are amazing at what you do. You're great at your job, and you're what I really like is your what's that?
I'm touched, man. That's really kind. Thank you.
Yeah, well, I'm gonna roast you in a second. So okay, first,
can't wait. Yeah.
So, but you are. What I love is that you really study the business, you study the industry. Your thing, and I'm gonna mess this up, but I'll let you introduce. You say this as well. But you really have a holistic approach to lending, right?
Yeah. So I guess I can extrapolate that out a little bit. So I was a financial planner for 8 years, and so I look at a loan as kind of like, if you think of like the balance sheet, right? And people tend to, when they think of financial planning, they think of their investments, which are one half of the balance sheet, but the other half is the debt. And we see people who are maybe borrowing not at the most efficient way possible to really maximize their net worth. So whether that's carrying high interest credit cards or paying on the wrong type of term for their mortgage. So I do really try and, with every client, look at that with them and make sure that they are, making their money work for them, as hard as they worked to get it in the first place.
Yeah, I love it. Yeah, I think that's it's what initially caught my attention. Yeah, I think you came in and did a presentation early on when we very first met. I'm like, wow, this is, you hear of mortgage advisors, but you don't hear of this, of what you just talked about. That's kind of a very, I think that's an interesting approach, and I appreciate it. So.
Oh, thanks.
Yeah. So, do you have anything to say before I hit you up with some of these questions?
No, I say let's go with the questions and see where they lead us. I bet we'll get a question. I bet it'll probably open up like new avenues, things maybe we didn't even think about.
Absolutely. Cool. Well, I have just so you know, I have my notes here. So I might take some notes from time to time, but on the answers that you give. So if I look down, that's what I'm doing. But all right, man. Kind of the big question right now is like, what is up? Like, what is up with interest rates and the volatility? I mean, it seems to me that they're all over the place.
You are correct. So they are. It is in a normal day, we get a rate sheet in the morning, and from all the different lenders who I use, and there might be some changes from the day before, but it tends to be pretty gradual. Nothing that really makes your eyes open. Over the past few weeks, we have seen multiple midday repricings. So what that means is that we can dive into that in a second, but for the gist of it is that something's triggering in the middle of the day that is saying, wait a minute, we can't offer these terms and this pricing that we were able to offer this morning. And one day we had 4 of them. So 4 times throughout the day, the major banks and lenders said, wait a minute, we have to change this. And it's been working both ways. So there have been days where we've zigzagged, reprice for the better. Nope, reprice for the worse. Wait, reprice for the better. Oh, reprice for the worse. I mean, just whipsawing all over the place. And that is, oh, go ahead.
No, go. Yeah.
Okay. I look like you're going to ask something. That is a direct result of where money really comes from when you're buying a home or refinancing a home, when you're securing a loan. I think people still have this idea in their head. I think back to like It's a Wonderful Life, that you go down to your local bank and the banker gives you a loan of money and that's it. But really, it is a factor of a very complex financial markets. Mortgages they're pulled together and they're sold as a security that people can invest in. And so right now with the volatility, particularly in the stock market, we've seen a huge sell-off in the stock market. And when people are selling their stock holdings and generating cash, they have to find a place to put that cash. And so it could just be, like, figuratively speaking, under the mattress, like just in the bank. But investors are still trying to get some sort of return. And so a lot of that money has flown out of the stock market, the equities market, and has flowed into treasuries and mortgage-backed securities. And so increased demand, just like toilet paper, increased demand drives the price up. And when prices go up on bonds, the yields drop, the interest rates drop. So there's been this huge demand for the safety or the lower volatility of fixed income, and that has driven yields down and driven rates down.
Okay.
Yeah. Tell me if I need to go more like plain English.
A bit more, yes.
Okay.
So, yes, please, more plain English.
Please, more plain English. Okay. So let's go back to the toilet paper. I think just because of the time we're in right now, if you go into a place that has toilet paper in stock, right, they're putting a limit on how many you can buy.
Yeah, you can only buy one. If there is a roll there, or if there's a package, you can only buy one.
Right. But given
if there weren't, get the guy in the aisle in order to take the one.
Right. Yeah. Just throw the forearm to him. If we remove some of the things that are in place of the store, where maybe the store just started allowing bidding on toilet paper, you would see, because it's scarce and there's way more people who want toilet paper versus how much toilet paper is available, you'd see the prices drive up, right?
Mhm.
And so it's the same concept, but instead of toilet paper, we're talking about a fixed income or a yield paying security. So something where you put money in and then you get interest payments in exchange for your money. So because there's been all this huge rush of money flowing out of the stock market looking for a home, it has driven the prices up on bonds. And bonds, the interest rates on bonds work counter to their price. So as the price goes up, the rates go down.
Okay.
And that's where we are, is that we have a bunch of money flooding that market. We also have the federal government stepping in now, saying that they're going to be buying mortgage-backed securities to basically keep the economy flowing, to act as what we call like a lender of last resort. So they're saying, hey, if we're worried about credit markets drying up, we are going to provide money so that they don't. This is what they did in the great financial crisis 10 to 12 years ago. The fancy word for it is they called it quantitative easing, but the layman's term is they were out there buying bonds to keep money in the economy and keep credit flowing.
Okay. So, so I think, I get this question a lot, and maybe you can help me to set it straight, or what, how should I respond to this? But the common question is, so, hey, I hear the feds are going to, lower the rate, right?
Sure.
What does that mean? Like, there's a lot of people, I mean, it's like down to nothing right now.
Right. Yeah.
Right?
It's
So,
essentially zero.
So why is it that mortgage rates aren't at zero?
Okay, that is a good question, because it is probably the most common question that I've received in the past couple of weeks. I wish I should have brought some props, but somebody posted this to a mortgage forum that I check in on, and they had a picture of apples and a picture of oranges. And the apples were labeled federal funds rate, and the oranges were labeled mortgage rates. And the reason
they're not connected.
They're not. They're somewhat. I mean, they're indirectly connected, but they're not connected. Mortgages are long-term loans, and so those are going to track long-term bonds, not directly, but closely, and that is akin to that whole supply and demand thing. So people are looking for longer-term places to park money. They have treasuries, they have mortgage-backed securities, and that's that. Now, the federal funds rate, that is the rate that the federal government charges banks and lending institutions to lend each other money. So that is going to have an effect on shorter term things like credit cards or car loans. So if you were in the market for an automobile, chances are the rates on that are going to be 1.5% lower than they were a couple weeks ago.
Yeah.
Yeah. So that's that. Go ahead.
There's some crazy deals out there right now, like 84 months, 0% financing on a new truck, and they'll deliver it within 2 business days, and it's just they're cutting deals left and right. So
and that's 100% a function of the federal funds rate being cut to zero.
Cool. I mean, yeah, makes sense. So, okay. So if the rates are, I guess maybe you already kind of addressed this, and it's supply and demand, but my next question that I had is like, to what do you attribute, all the ups and downs?
Sure. So the ups and downs are an indirect or a direct function of the ups and downs in the general. I don't want to say the economy, because the economy is way more than just the stock market, but the investment economy. So it's money flowing in and out of the stock market at large and the bond market that's causing this. Another thing that we're seeing too, it all goes back to that Econ 101, the supply and demand, but the because rates dropped so low so quick, there was a huge flood of mortgage applications. And so lenders actually were increasing their rates because they were at capacity for processing loans. So they had basically too many applications and not enough underwriters and processing staff to get them through. So they artificially inflated rates to kind of hold back that tide a little bit so they could work through what they had. We're starting to see that kind of relax now, which is good. But there were a few days there where it was pretty wild. The reprices we got for the worst. They're basically saying, don't send us any more business right now.
Okay.
Yeah.
It's nuts.
Right. That's I think they call that a good problem. Yeah.
Yeah. Well, for them, right?
For them,
and
right.
For home
somebody
buyers,
trying to get a home, not
yeah.
so much. That's a big problem.
Right.
Yeah.
So okay, so this is this will kind of relate to my next question, which has to do with qualifying for a home. But actually, let's stick to that topic that you just addressed, right? Like basically, hey, we don't need any more loans right now.
Right.
And supply and demand, that obviously has an impact on. I mean, they're going to still at that point in time, they would still do a loan. It just was going to be expensive. Is that right? Or
yeah, and expensive in relative terms. It was expensive relative to a week before. In the grand scheme of things, a 4% mortgage is not terribly expensive.
yeah.
I mean, ask your parents, or I remember, my parents, their mortgage was at like 12%. So
Right.
a 4% mortgage is still very, very inexpensive money. It's just not as favorable as it was the week before. And it's already, we're starting to see it kind of relax again. And, as they work through that pipeline of business, then they're going to relax that and want more business again.
Okay. So for now, though, at least, how are, with interest rates kind of bouncing around like they are, hopefully they flat. It sounds like we're maybe already starting to see them kind of calm down.
We're starting to see them flatten out, but we're still seeing a lot of volatility. That's kind of open up a new thing that I should touch on, is that in particular with the way things are right now, as far as uncertainty, lenders are instituting policies of being unable to lock a loan until you've reached certain milestones. So maybe let's unpack that, since I kind of opened it up. When somebody locks a loan, what they're really saying is, hey, I am committing to doing this loan, and I want to protect myself from any price changes. So I'm going to commit to today's pricing. And what happens at the lender is they execute what's called an options contract. Basically, they put down some money saying that, no matter what happens, we're securing today's pricing. What happens?
A rate lock, right?
A rate lock. I think most people are familiar with it, but they don't know they've never popped open the hood and actually looked at underneath what it is.
Okay.
So it's the lender. Some lenders will charge a rate lock fee, but most of them don't. And it's that's why a lot of lenders too will ask, like, we're not going to lock your rate until you pay for an appraisal, because then they know you're committed. You have some skin in the game, because they're going to have skin in the game when they pay the premium to actually lock the rate. What's happening now is, because there's uncertainty with the economy in states that have declared a state of emergency, like California, they are requiring that the loan has met certain milestones, like it's been underwritten, that the appraisal has come back, because they don't want that loan falling out. I think the biggest thing right now is employment. If somebody starts, gets into the process, they're buying a home, and unfortunately, if they get furloughed, or if they're sent home, or if they're laid off, then that loan is not going to close. So these lenders are basically kind of hedging their bets, and they're making sure that we're much closer to the finish line before locking. Some of the lenders I use are offering incentives, so they're cutting their margins on their 15-day rate locks to try and compensate for that uncertainty. But it is somewhat uncertain because you go in to buy a home and you're told, well, this is the pricing today, but there's no guarantee that this is going to be the pricing when we're done. So it does take a little bit more, I guess, resolve, and it's a little bit more stressful. But when we talk about rates changing, we're not necessarily saying that we start today and you're getting a 3.625 and 2 weeks later you're at 4.5. It's not that so much as we're at 3.625 and right now it has a credit to you of $200 toward your closing costs. And 2 weeks from now, it might have a $1,500 credit toward your closing costs, or it might cost you an extra $800. Neither one of those things, when you're talking about buying a $400,000 or $500,000 house, those things shouldn't make really any difference. In the grand scheme of things, you're talking about pennies. So it's not quite as scary as it might initially sound, but it is something that we're dealing with right now.
Right. And I have a question about where I was kind of leading, and thank you for explaining, but I was kind of leading towards my next question has to do with qualifying based on that environment. But I guess since you just kind of teed up the, another one for me is if you're talking to a buyer today and their rate is 4,
mm-hmm.
and they lock in they buy a house, which is happening, sure. And they and then in 3 weeks from now or 2 weeks from now, the rate is back down to 3.5, which is what we're kind of thinking might end up happening, right?
Sure.
How do we address that? I know we've run into this situation together before, and I know how it was addressed then, but maybe if anything has changed, or if you want to just kind of share that story, because it saved our clients. Like we were working together with these clients, it saved them like 12 grand. Like it was crazy.
Right. So that was good. That was a fun. I remember being nervous because I know real estate agents get nervous when you say that you're switching lenders. But in that case, it worked out well. So let's backtrack there. There are a couple of ways to do it. Banks will offer what's called like a rate float down. In my opinion, it's kind of an insincere promise might be the best way to put it. Because if you read the fine print on it, rates have to improve by a certain level, which is, in and of itself a pretty steep hurdle to climb. And then also they'll charge you a fee for it. So me being an independent broker, I don't work for a bank. I have wholesale access to a whole slew of banks. And so in the case that we were just talking about, what we did was we locked in. There was a huge shift that made pricing just that much better. We had a complete file, so we just moved it to a different lender and took advantage of that. So that's one of the things I do is I'm constantly monitoring everything in my pipeline to make sure that clients get the very best deal on their house, because that's I just think it's the right thing to do. And in that, I mean, it's not in essence, it's a little extra work because we have to register a new loan, but it's not really a whole lot of extra work, and it just makes a lot of sense. And people remember that they'll be my clients for life because people don't forget when you look out for them like that.
Yeah. Well, what I love about that particular example is it was an unsolicited, hey, I think we can do this. And everybody was like, oh, okay, sounds good. It wasn't like we were following the market. And we're like, hey, we got to sell, buy. You were like, hey, by the way, we can flip this over and save you 12 grand. So,
right. Yeah. Well, I think most people, when they think of getting a loan, you and I talked about this yesterday, that, nobody wants a loan. people want a home. They want a house with a nice backyard and a pool and a place to have Christmas, but nobody wakes up in the morning saying, wow, I really want a mortgage. Um, so I try to make it as pleasant as possible for something that nobody wants. And yeah, I try and provide that extra level of looking for people.
Cool. Well, I know it's been a big win for a couple of our clients, and that recently that we've worked with. So it's working, man. I have more questions, but I think we have quite a few that have dropped in on Facebook. So I think we already asked. Oh, shout out to my dad. My dad's watching.
Hey, Ron.
Ask him what his interest rate was. Like you said, ask your parents. Let's see what the highest, dad, if you're still watching, what was your highest interest rate? But it looks like you already answered his question. He was going to ask about mortgage-backed securities purchased by the government, which I think it sounds like that's the direction that we might start heading, right?
I'm sorry, there was a notification just popped up and it completely ruined my train of thought. Can you say it again?
Yeah, it sounds like we already beat him you already answered this, but he was going to ask about mortgage-backed securities purchased by the government.
Oh, right. So yeah, let's go over that again real quick. It's that the government is stepping in to basically put liquidity into the market, or make sure that there's still access to the funds needed to fund loans. So they're basically injecting extra cash out there to make sure that markets function correctly.
Good.
Yeah. Yes. Thank you.
Music to my ears, right? And especially and for any homeowners' ears as well, right? Like, we want to know that buyers have options. The money's still, when money's cheap, it's a win-win for everybody, right? Or when buyers can get loans easily, or not easily, but when they can get them at a reasonable price, it's a win-win for both buyers and sellers.
Absolutely. Because those sellers, they're not going to be, they don't disappear. They're moving into a new home, so they need that as well. Yeah.
Sure.
Yeah.
I don't know what this means exactly, but John Puther asked, are we in a new QE1 now?
Oh, QE1. So he's referring to quantitative easing. I don't know if they've officially named it, but yes, what the government's doing right now is just like QE1.
Okay. Oh, those two are that's related. That's what we're just talking about. That's what.
So QE is quantitative easing. It's a fancy way of saying the government is stepping in and buying securities.
Okay. Yeah. Cool.
They should just say that instead of, nobody knows what QE is, but if you say, oh, the government's injecting liquidity into the market, that's easier to understand.
Right. Oh, and it's a mortgage, even simpler. It's a mortgage buyout.
Yeah. Well, yeah, it's basically them giving, so there's Fannie Mae, Freddie Mac, who are, they package up all of these loans and securitize them and sell them for people to invest in. That's a great thing. The Big Short, if people want to kind of understand this stuff, I really recommend that movie. I find it super entertaining. I do really love the two really kind of shady mortgage brokers in it, because that's one of the real blessings, or the silver linings of the crash of about 12 years ago, is that there's some new barriers to entry. So there are bad actors, bad apples in every industry, but it really made it, it made it a little bit more difficult for people like the guys in that movie to be doing mortgages. So that's just an aside, but that's a great resource to learn kind of how they package and sell these as securities.
Okay. Another question. We actually have a couple more questions too. This is awesome. I love it.
Oh, nice.
Question from Renee. is, or it's a comment question. So basically, and this was, I think, back in reference to kind of the volatility, and then you saying, well, we're expecting a bit of a flattening, right, or a melt, or it to calm down a little bit. And my connection said unstable, so I hope are you still with me?
I'm still here.
Cool. So basically, then be ready for when rates drop again. Like, so then to be ready so that when rates drop, should people like work with their mortgage broker now and have all the document done and kind of ready so that they can act? Or like, what, I guess, knowing that rates will probably begin to flatten out, should they just jump in now? Should they get everything kind of ready, and then as soon as they do go back down a little bit, lock it in? Or like, what do you advise there? I think she might be thinking more of like a refinance.
Okay. So on a something like that, I would say have that conversation with your mortgage advisor. Talk to them about, you know, where you are now, what you're looking to accomplish, and from there, like, are you in the ballpark of things making sense to look at that as an option? So if you're somebody who has like a 3.5% mortgage, it's probably not worth your time unless there's some other factor where you just need, you need cash, or you need, you have a bunch of high interest unsecured debt that you want to consolidate. But if it's just simply to get a lower rate, I wouldn't be too terribly worried about it. But if you're up kind of in the higher 3s to 4s, have that conversation. And then what I would do is I would have, like you said, have everything kind of on file and monitor it. And then there's if there becomes a point where it makes sense, then move forward. So I did this with people I talked to last week, and I had to have the unfortunate conversation of, I think we may have missed the boat, and right now it probably doesn't make as much sense as it would have a week or two ago. But we collected all the info, and then it was a real nice phone call this past week where I said, hey, look, this makes sense again. We're back to where this makes sense, and we were all ready to go, and their loans flowed through very, very smoothly because it was all front loaded, and we'd done all the work ahead of time.
Cool.
Yeah, I think the big thing is just ask, reach out and ask for an honest opinion.
I guess, yeah, and I could see that I could see that being maybe a tough question to answer specifically. Like, how do you blanket statement, right? But in general, the answer is probably yeah. So have everything ready. If it's something that you want to do and you've thought about it, then have the conversation and get everything ready and do it.
Yeah.
Or wait,
Right. The worst possible outcome there is that they don't end up improving, and so what? Like, you have some PDFs in a file. Like, it's not really a bad, there's no real downside to that.
Cool. All right. So we've been live for 30 minutes. So I planned on being live for 30 minutes. So, and I still have more stuff. So thank you, Drew. But so there's some other things that are really happening right now. Like, I wanted to ask about a non-QM loan. Like, what does that mean? Because
okay.
Something I've read recently about in articles,
Sure. So a non-QM loan, it's a non-qualifying mortgage. I'm going to refrain from doing like the super technical definition, and more so of a non-QM loan is basically like a non-vanilla loan. So when I think of, and when you think of, and when most of the people on this probably think of a traditional loan, they think of a 30-year fix that's fully amortized, and you provide pay stubs and W-2s to qualify for it. That's a QM loan. A non-QM loan is going to be something that's different than that. So maybe it's an interest-only loan, or maybe it's a loan where you're using bank statements to qualify because you're self-employed and you don't have, and maybe you write too much off and your tax returns don't reflect your true income. So something where it's akin to use the nasty word, the subprime loans. It's not the same as that, but it's something where the guidelines are not as stringent or flexible. Yeah.
Okay. And as of now, are those gone, or are they?
As of now, yes. And I think this will go back to when we're talking about the quantitative easing, or the government injecting money into mortgage securities. Those types of loans, they're privately funded, and so the market for them has evaporated, and because of that, there's no money to lend right now. And so yes, those are basically evaporating right now. Yeah. Now what happens, remains to be seen. Hopefully things settle down, and those will become available again. They're not, sorry, somebody's texting me something who's watching this, really really making me laugh. Yeah, they're not terrible. So I had somebody who had to do a bank statement loan. They make great money, but they have a lot of write-offs, and it made sense. I think that the one thing we're trying to avoid is another thing where people are getting mortgages that they can't pay for. So you still have to show the ability to make your mortgage payment.
So how, if you have 20 people that you talk to in a month about pre-qualifying them and getting them ready to buy a home, are you still with me?
I am. Sorry. I need to figure out how to put this on Do Not Disturb. There we go. I just declined the call. There we go.
If you have, a bunch of people that are trying to get qualified for a loan, 20, let's say, how many of those 20 on a typical month or week or whatever are non-QM? What I'm trying, yeah.
For me, I don't talk to too many non-QMs. And that might just be, I think that's common. I don't know how, I don't specialize in it. And so I think you'll find people who that's what they specialize in, and maybe they advertise to that. I handle them when they come up, but I mean, we're talking less than 5%, probably less than 3%.
Got it. Yeah. So 1 out of 20, maybe.
Oh,
where I was going with that is like who might be removed from the market because of this, like in terms of my buyer pool. But it sounds like maybe less than 5% is going to be unable to buy a home.
Yeah, it's going to affect somebody who is self-employed, who might be in a very cash-heavy business, who exaggerates on their taxes or embellishes on their taxes to minimize how much tax they pay. It's the great trade-off. You pay less in taxes, but you also qualify for less home. So the rule is you can't tell Uncle Sam that you make X amount and then tell the bank that you make Y amount. Those numbers have to match up.
Yeah. Okay. If you have, there's another question from the people watching, and I'm going to ask it soon. It's from Dina Irwin, and she said, "Can you talk about the pros? The pros of a reverse mortgage."
Oh wow! Okay, that's
and maybe to help, and I know this is an area that you specialize in, right? You aren't necessarily the reverse mortgage only guy. I mean, you do all loans. And so, but still, to give context for the rest of the people that are going to be watching this, not all audience members are 62 and over. So, but maybe if they have a grandmother or a grandfather or somebody that they know, like specifically right now, what would be the pros of a reverse mortgage?
Sure. So, I mean, I could talk probably a full hour about this, so I'll try and really.
That's why I tried to rip.
Yeah. So a reverse mortgage, I think of, even though it is by definition a mortgage, it's borrowing money that's secured by a home. It really is more like a financial planning tool. And so right now, if you think of somebody who's 62 or older, who's living in their home and is retired, retirement is essentially like the drawing down of assets that you've accumulated over life. And traditionally we think of that like I invested in a 401k, and now my 401k is worth, X amount of money, and my plan is to draw a percentage of that each year to live off of in conjunction with Social Security, and if you're fortunate enough, a pension. But the problem or the challenge that we have, and it's really, really evident right now, is that we have a market that just sold off. So if somebody is banking on that 401k money, and they were planning to say take like 4% of it per year, well, now that their balance is lower, now they have a big question. Do they continue taking 4% of that new smaller amount and adjust their lifestyle?
Yeah.
Or do they take the same amount of money and risk depleting their assets a lot faster? So there's a lot of research coming out of MIT, University of Pennsylvania, Ohio State. So not crackpot people in a basement somewhere, like legitimate people are looking at this and running actuarial tables and running simulations. And what they found is that there are times where it makes more sense because remember, retirement is drawing down assets you've accumulated. And the average baby boomer right now has more than half of their net worth in equity in their home. And times like these, the research shows it's actually more efficient to take that from the house. Especially right now, we're in a really low interest rate environment, which is good for borrowing. It's not so good when you're like taking from your bond portfolio and your bonds are paying 1%, if that. If you're withdrawing and your bonds are paying 1% and your stock portfolio just dropped like 35%, that's a really inefficient place. Whereas that low rate, borrowing against your house at 3.5 or 3.25 is really efficient. And what that does is it allows that money you normally would be taking out to stay there and take part in the recovery.
Makes sense. Yeah. We're in a low, stock market's low, the market's low. To pull your money out now means you assume that loss right away.
100%. And I would, to give a little plug, I'm on the board of the Financial Planning Association of Northern California. If this is something that anybody watching this is concerned about, if they're in this age range, I can absolutely put them in touch with a good certified financial planner in their area. I know a lot of them through the association. And those are people who are not there to sell you a mutual fund or an insurance policy. Those are people who are there to look holistically at, should you defer your Social Security, or how are you going to pay for healthcare, stuff like that people really need in retirement. Yeah.
I think we should get some of those guys on the line, and we should do another live on that, specifically on that, and get people in here that are 62 plus that could take advantage and actually use one of those, use that as a product.
Sure. And actually, we got to move on, but one thing I should talk about is you can use a reverse to buy a house. It's great for somebody, if you have somebody who says, I don't want a mortgage going into retirement, and let's say their budget is $400,000, and of course the dream house is the one that checks all the boxes, is like $460,000. We can make that last gap, that 60, work by doing a reverse for 60. They're still in the house without a mortgage payment. That's something that people should be aware of.
Awesome. Okay, so we've talked about interest rates and like the tech or the technology behind them, like why they are the way they are. We've talked about what's happened so far, what maybe will happen hopefully in the future in terms of them flattening out, but who knows, right? So I want to kind of wrap this up with timing. Like right now, I have some people that have called me and they're putting their decision on hold, right? They're not going to move. They're not going to buy. They're not going to sell. And, we're supporting them in their decision 100% because it makes sense for them. I have others that need to buy or they're moving. Like it was their plan. They're moving right now. And so the $1 million question that I always get is, right now a good time to buy? And so I guess I'm just gonna push that over onto you. I just want to know your input. Like, is right now a good time to buy?
Okay, so that is a really good question.
let me help you with this. Let's just assume, there hasn't been a catastrophic event in their life. There's no, the job outlook is looking pretty good, right? They're not fearful of that, and everything's relatively normal.
Okay, sure. So let's look at maybe two different scenarios. The first one is somebody who currently owns a home, and maybe they're a move up buyer, or they're downside, whatever. There's some reason that their home they're in right now is not the ideal home for them anymore, and they're looking to move. The attitude of like, well, I want to wait and see if things calm down. I think what they're really expressing is, well, what if we see housing prices drop a little bit? And that's a valid concern, but the fault in it is that the home that they want to buy, if that does drop in value, the home they're in is also going to drop in value. So the key is that as long as you remain a homeowner, you're going to ride that out. So in that case, I don't think that it's something to be concerned about, because it's going to be a constant, whether you own current home or you own the home you'd rather have. Either way, you're going to be riding that wave. So that's scenario one, where I guess the short answer is no, it really shouldn't matter. Scenario two is somebody who's a first-time home buyer. In that case, there's two things to look at. Number one, you need someplace to live, right? And so that person is, if they're not a homeowner, they're renting. And so they're paying rent. And depending on what they're paying in rent, I mean, that's money every month that just lines somebody else's pocket and makes somebody else wealthy. Owning a home means that you make that payment, and yes, a big chunk of that goes to interest, especially in the beginning, but you're also paying into your own savings. And study after study shows that the biggest effect on somebody's net worth and financial health is whether they own a home or not. So either way, I think you're good. One other thing I'll add too is that because interest rates still remain at like historic lows, buying a home today is exactly the same as buying a home like 2.5 years ago when rates were higher. Even though we've seen home prices come up over 2.5 years, the cost of borrowing is less. And so the actual cost of ownership, like if you extrapolate that out to 360 payments over a 30-year loan, you're going to pay the exact same amount for a $500,000 house that you would have paid for a $460,000 house a few years back.
I actually have a pretty cool I actually have a pretty cool thing on that, and I'm going to share it real quick. Let me know if you can see this.
Let's see.
Can you see my screen?
I can just see that it's started screen. Oh, nope, can't see it. I can see you again.
Let me see one more time. Oh, that's not.
Oh, there we go.
Can you see this? Buyer's purchasing power.
Yes.
So I think this is kind of cool. This basically shows the chart of interest rates, right? And what it does to their purchase power at a $500,000 mark. So as interest rates go up, or as interest rates increase, the pricing of their home decreases.
Right. And that's the big unknown, is that if rates don't, if they turn around, and they did, even 2 years ago, we were looking at interest rates at 5%. If they turn around, and people are worried about the home price dropping, well, it's still going to cost you the exact same amount if that happens. I wouldn't wager my future on it. It's basically what I'm saying. You need a place to live. Now's a good time to be a homeowner, and it really pretty much always is a good time to be a homeowner.
Yeah. Okay.
Yeah.
All right. Cool. I'm with it. I like that answer.
Yeah.
And I believe it too for the majority of people. I think some folks, like I said, circumstances, income, job outlook, stuff like that is certainly going to play a factor going forward.
Yeah. That the shortcut for like what it takes to get a loan is the 3 C's. So they're capacity, collateral, and credit. So capacity is your ability to repay. You have this much that you're obligated to pay each month. Do you make enough to pay that and put food on your table and live your life? The next one is credit. How responsible are you with money historically? And the last one is collateral. How much are you putting down on the house? So it's loan terms are more favorable if you're putting 20% down versus 10 because you have more skin in the game. The lender has less risk. But that's basically it. So as long as you have the capacity, you should be okay.
Okay.
And that's where we got into trouble, a decade plus ago, is that you had people who weren't demonstrating the capacity and they had no collateral. They had 0% down on a house. So when things started going sideways, it was really easy for them to walk away. And yeah, we've worked really hard to, when I say we, I mean regulations have worked hard to get rid of that so that we don't hopefully experience anything like we did in 2008, 2009, 2010.
Yeah. Okay. Last thing, man, real quickly, I know we're going to have stuff up on our website. We're developing a news category on our website so that we can keep people up to date as things are changing all the time, right? We used to have a monthly marketing plan, and now we're literally having like a daily marketing plan where it's just things are changing all the time. Anyhow, what are some good resources that you would recommend? And maybe we can put them on our website too, that we can check in, maybe keep an eye on mortgage rates, keep an eye on mortgage news. Like, do you have what would you recommend to check out if you're interested in this kind of thing?
Sure. So I'll give you two answers to that. The first one for like a very specific mortgage resource, it would be housingwire.com. So that's a place where people can kind of go and just get up-to-date information on where things are. My favorite, and this is, it's certainly not just mortgages, but it's kind of economics as a whole, would be there's a radio show, Marketplace. It's on 3 o'clock every day on public radio. It's entertaining. It's really, really informational, but it's delivered in a way that's like easy to understand and applicable to real life. So it's not a whole lot of abstract stuff. It's more of like, we're visiting a cattle rancher in Wyoming and talking to him about like the ebbs and flows of his business and what effects things are happening. Because I think I mentioned this earlier, that the economy is not the stock market. The economy is everything put together, and it does a really good job of explaining that. And there's a lot of housing on there too. But I would recommend that probably more than anything if people are interested in learning a little bit more, because it's easy to digest, but it's quality.
Say it again so we can drop one of the team, Laura.
Sure.
Can drop a link in there.
It's Marketplace, and it's on locally. It'd be on 90.9 at 3 p.m. weekdays.
Okay, cool.
And I think they're online. I think it's Marketplace APM. It's probably their Twitter handle, and at Kai Rizdal, KAIRYSDALL, 2 L's. He's the host. He's awesome.
Google it. We'll drop it in there for anybody that's watching this later, and like have that resource. But again, and we'll drop a link to our news page as well. Maybe we'll just have that link in there in the news page, some resources for people. So cool. Well, Drew, I appreciate you. Thank you for sharing your knowledge for 53 minutes here. I know we went a little bit long, so thanks for bearing with us. Do you have any other thing that you want to say?
I don't. I mean, nothing. I guess just with the way things are right now, just it's things will pass, things will resolve. It's scary out there, but just things will be okay, and people will be okay. So yeah, that's all I really have to say about that.
So, and I'm with you 100%. Right now is the time to have a solid tribe of people. I think over the next couple of weeks, few weeks, we're going to see some really scary headlines. We're going to see a lot of things happening in the economy. GDP's down, just plummeting, right? And so there's going to be some really scary stuff happening. And I think who you have in your tribe is very, very important. That's why I have that solid tribe group, right? And anyhow, man, I'm grateful for you. Anybody that's watching this, reach out to Drew directly if you have questions. He should be tagged in this page. If not, he will be. Hit him up. He's the guy I bug for questions or for answers all the time. And I think that's fair, right? Anybody that's watching this can hit you up.
Absolutely. And man, that's, again, you're awesome. And I appreciate you. I appreciate you too. And I appreciate you including me on this. I've actually had some fun doing this.
Cool. Can we drop your, what information can we give? Facebook works. I mean, should we post your phone number in here?
Yeah, you can post my phone number. I joke, it's not funny, but I'm really, really good at understanding finance and loans. Pretty terrible about like marketing, and I'm working on that. This, but yeah, right now it's my online presence is not the greatest, but I'm old school. Call me.
What's your number?
It's 916-801-0505.
Nice. I just dropped that in the comments too. You guys check it out, or find it there and give Drew a call if you need anything.
Cool.
Awesome, man. Thanks so much. And we'll do this again.
Sounds good. Thank you very much for including me. I loved it.
Got it.
All right. Bye.